Hey everyone, this is Robert with GoldSilverPros.com, and I'm here with Dave Kranzler, whose company Golden Returns Capital and website is investmentresearchdynamics.com. He writes for Seeking Alpha as well as for his own website. Dave, how are you doing today?
I'm doing well, thanks. Thanks for having me on.
Yeah, thank you very much for joining. I appreciate that. I know that we both write for Seeking Alpha as well as some other outlets, and I've been meaning to get you on the program for a while, and I'm glad we're finally able to sync up.
Yeah, that sounds great. I'd also just like to add, I publish a weekly newsletter called the Short Sellers Journal and a bi-weekly newsletter called the Mining Stock Journal, and those you can access off of my website.
Okay, and that's the Investment Research Dynamics.
Yes.
Okay, fantastic. So yeah, I think I've looked through a lot of the stuff on your website, and I find it quite helpful, and appreciate the information that you give. Would wholly encourage people to subscribe to your newsletters, because I think the information that you put in the public domain is very good. So I definitely appreciate you doing that.
Oh, thanks. I appreciate it.
So we were chatting a little bit about inflation and about CPI index and things before we started the recording. So I didn't know if you wanted to start there, or if there's anything just burning a hole that you wanted to really talk about that you're seeing lately with regards to the economy.
Well, in terms of burning a hole, it's just, what's kind of blowing my mind right now is the divergence between what the stock market's doing and what the real economy is doing. And at some point, either the real economy is going to have to catch up to the stock market in terms of real economic growth, or the stock market's going to catch back down to the economy. And I think it's probably going to be the latter. So this is, I've been involved in finance and stock market activities since 1985 when I graduated college, and really before that. But this is probably the nastiest bear market rally that I've ever seen. And I think it would be a mistake to make the assumption that there hasn't been some official intervention to help the move, to help the stock market recover from that sell-off in December.
Okay. And getting to your first point about one of the nastiest bear market recoveries or bounces, if you will, that you've seen, can you kind of explain why you think that this may not be a true recovery, and why the stock market is sort of separating from the general economy, and why that seems to be particularly worse than what you may have seen in leading up to past recessions?
Sure. Well, it was a coordinated effort between the Trump government and the Federal Reserve to get the stock market to bounce. If people remember, the Treasury Secretary came out over Christmas and made a big deal out of convening the heads of the big banks, and some of those people sit on the board of the Working Group on Financial Markets, which was authorized by an executive order signed by Ronald Reagan in, I think it was 1988. It was authorized to interfere or to intervene in the stock market in order to create stability when the stock market becomes unstable. And over the years, it's hard to prove, but it's highly likely that the Working Group on Financial Markets, via the Exchange Stabilization Fund, has its tentacles in all the markets. So, but the bounce that we've seen in the stock market, to the extent that the stock market is supposed to be reflective of the relative health of the economy, the bounce is completely diverged from what's going on in the real economy, and we're seeing that with the numbers. And most recently, I guess China released a purchasing managers index number that was construed as showing green shoots in China. And I find it kind of amusing that, when China, for the last 10 years, when China's been reporting, incredible GDP growth, everyone out there is saying, oh, well, they manipulate their numbers and the numbers are rigged and they're not real. Well, all of a sudden they report this slightly positive PMI, and a PMI index is kind of it's kind of what I call a soft, quote unquote, soft economic index anyway. All of a sudden it was green shoots, and that spurred on the 300-point bounce in the Dow we saw yesterday. So if you look at, I study intensely all of the economic reports that are released, private sector and from the government, and if for the most part, those reports are reflective of an economy that is headed into what is probably going to be a pretty nasty recession.
Yeah, I think I agree with you on that. And one of the things that we had also talked about by email before the interview were the other economic data points that we both study, and it has to do with housing, the auto market, consumer confidence. On the debt side, you have yield curve inversions. On the retail side, you have manufacturing. You mentioned the PMI index for China. I think the PMI index for a lot of different countries, including Germany and the U.S., would fit into that bucket as well. There's also capital spending trends, shipping, consumer purchasing, retail sales. All of these numbers seem to be trending down at the moment. I don't see a single one of them that show where we're heading into a stronger economy. And I think that the real numbers are showing or saying recession is coming, whether it be this year or maybe early next year. And yet the stock market seems to rebound and continue to rebound after the bad quarter, fourth quarter last year. And I'm trying to figure out exactly why. Exactly why would the stock market be rebounding when all of these economic numbers are showing that the consumers are tapped out? There's risk going up in the debt markets, and bond traders are usually very in tune with what's going on in the economy, and that's how the rates are set in that market. And all of these different manufacturing indexes and even capital spending indexes are going down. Why is the economy continuing to go up? What do you think is the main driver for that?
You mean the stock market? Yeah. Well, data shows that I think something like 90% of the stock market volume is now controlled by hedge funds, or not necessarily controlled, but it's hedge fund trading is 90% of the volume. And as everyone knows, a lot of these momentum-based strategies use computer algorithms, and it's computer driven, and to me it's what it is it's chasing momentum higher at this point. And it seems like again, it's not a conspiracy theory when every time the market starts to sell off, one of the exchanges all of a sudden has an outage. Like the NYSE had an outage this morning, and it halted a sell-off that was developing. And we've seen it a lot of times with the NASDAQ or the ECNs that are the fiber optic data channels that feed into the NASDAQ that people trade through. So and also the fact that the Fed has basically said it's going to stop its quantitative tightening, which is essentially it was trying to remove the money that it printed and put into the financial system. It was trying to remove that, and everyone who understood what was going on knew that they weren't going to be able to do that. And lo and behold, they're going to stop that initiative with maybe only having removed about 10% of what they printed over the last 10 years. So they're leaving a lot of liquidity sloshing around the financial system, and you give that to banks, and banks extend credit to hedge funds, and hedge funds can go crazy on margin with their computer algos. And I think that's pretty much what we're seeing here. The numbers that I look at from my short sellers journal seem to indicate that the retail investor is still pulling money out of the stock market.
That's a very important point. And not only I think is a retail sector pulling money out of the stock market, and you can see that in the volume numbers. I did an article on my website a couple of months ago about, and I just said, what stock market recovery? Even though we were bouncing as we came into the new year, the volumes were really low. And so that told me that without actually doing as much research as you had into the retail investor, that retail investors weren't in the game. because they tend to be, the additional marginal buys in the stock market that you'll get. And if you have weak volume, usually retail investors aren't investing a lot in it. It has to be somewhere else where this money is coming into the market. And another piece I wanted to throw out there was I graphed out the insider selling, corporate insider selling since the last recession, 2008, 2009. And net, there's only been 2 periods in which they were net long on their purchases. So for the last 10 years, they've been selling out of the market. So you have, I think the insiders, the corporate selling out. I think you have a lot of retail investors pulling money out. And so it makes sense where it could be hedge funds or certain other funds are sort of pushing this up, pushing the momentum up because they may be looking for returns.
Well, and you don't necessarily need to have cash come into the stock market to drive it higher. All the banks have to do is extend margin credit to the hedge funds. And the hedge funds can take that and turn it into, debt behaves like cash until the debt has to be repaid, right? So right. It's the same thing, extending margin credit to hedge funds. And we don't, the margin numbers don't necessarily pick up how much credit is being extended to the banks by the prime brokers, because those are debt transactions between the prime broker and the hedge fund. So, you can, and you also have with all these stock buybacks, you have shrinking supply of stock. So, between credit extended to hedge funds and supply coming out of the stock market, it's not that hard for, computer algos to chase the market higher. Now, if you remember when the stock market was tanking in December, Leon Cooperman was interviewed by the Wall Street Journal, and he was whining about the computer algos driving the stocks lower. Well, I don't hear him whining about computer algos driving stocks higher now. It's like the algos are great when they're going your way, but when they're pushing the market lower, all of a sudden they become these evil tools of manipulation.
Yeah, there's some really good points there. So in terms of getting back to the economy a little bit, we were also talking about debt levels, and I asked you a question leading up to the interview about debt at 3 levels. We have national debt, we have the corporate debt, and we have personal debt. What are you seeing in each of those 3 fronts, and what do you think that portends for what's going to happen in the next recession? Do you think that's driving us to the next recession, or is it just going to cause more pain when we get there?
Sure. Just real quickly, I wanted to circle back because I just remembered I had a great chart in my last short seller journal released on Sunday, and it showed the relative liquidity in the stock market. And if you look at the relative liquidity of the stock market during this bounce, it's even lower than it was when the stock market bounced in 2009. So the point is that the stock market now is actually more dangerous to be chasing stocks higher, because when you go to sell, first of all, a lot of the short interest has been squeezed out of the market. When you go to sell, there's not going to be a bid.
And that's where you get the big crashes, and that's a good point to bring up. When you have people trying to sell and there aren't enough bids, that's when you get the big ticks down on the charts where prices can drop, 5, 10, 15, 20, 30% in a period of time. And they're going to fall until somebody's willing to take on, that security at the price that they want to. And they may have a 20 or 25% discount on a given security. And so they'll say, sure, I'll put in a buy order at this price. And until you meet that price, I'm not going to buy it. And that's a really good point. If there's not a lot of liquidity going on in the stock market, that means there's not as many people bidding at any given price. And so prices are going to fall more than they normally would in a very liquid market. Right.
It kind of tells you that the move higher isn't being confirmed by volume or just sort of quote unquote energy behind it. It's essentially it's a chart that was sourced from the Financial Times. And it kind of confirms that, what we see going on right now are hedge fund computers playing musical chairs with each other, hoping that they have a seat when the music stops. Kind of the greater fool theory.
Yeah, and to expand on that a little bit, I know because you and I both write for Seeking Alpha. Seeking Alpha really is like a crowdsourced site on investment research. And a lot of the stuff that you see on Seeking Alpha is talking about sentiment. There are a couple of prominent authors that talk about sentiment And there's one author that wrote an article recently that said sentiment shows that it's blue skies ahead for the economy and then for the stock market. And if you just look at sentiment numbers, popular sentiment numbers, I do think that there's reason to be positive about it. But I think you really have to get into the underlying issues with the economy and with debt and with stock volume trades and who's getting in and who's getting out to really understand the risk. And I think a lot of retail investors really, especially if you have a 401k or a pension or an IRA in which you have a lot of these stock investments, you may not realize the amount of risk that's in the system if you're not really paying attention to all these economic numbers. And that's why I think newsletters like yours are very important for people to get a more in-depth view of what's really going on in the economy so that they're not the ones getting stopped out in their investment accounts when we have a big crash.
Sure. So just to address your point about or the question on debt, I mean, obviously you can go to the Federal Reserve website. I use St. Louis Fred, the Fred database. It has great charts on there. But every level of the system has a record level of debt. Mm-hmm. That's, you start at the top with the government, which obviously every second that ticks by, the debt level for the government hits a new record. Corporate debts at a record level and household debts at a record level. And the reason why we're gonna have a very, very nasty recession. I mean, I think we have been in a recession for probably the majority of the households in the country. Certainly, at least 80% of the households probably never really felt an economic expansion the way the upper 1% or the upper 5% have over the last 5 or 6 years. But there's another chart that I put in the Short Sellers Journal, and it graphs. It comes from the Fred database, and it graphs personal interest payments going back to 1990. And you can see 3 distinct peaks in the growth of personal interest payments. One is in the year 2000, one is in 2008, and one is right now. And the peak, the level of personal interest payments right now it far exceeds that level in 2008. And what that tells me is you basically have a strapped consumer. That doesn't mean that, the guys in the top 10% of the income demographic are feeling pinched, although I think a lot of them probably are. But it means that, and we've seen the data. I mean, something like 78% of all households essentially live hand to mouth from paycheck to paycheck. And I can't remember the exact number, but a shocking number of people don't even have enough savings to cover an unexpected emergency, like a medical emergency or whatever. So, essentially that's going to choke off demand. And I think that's what we're seeing right now. We're seeing, retail sales. Part of the swoon in the economic data during December and January was supposed to be because of the government shutdown. Well, guess what? Retail sales fell 2.2%. And if you strip out gasoline, and gasoline was a product, the gasoline, supposedly gasoline sales increased 1% from January to February. But if you look at the price of gasoline during February, that entire increase in gasoline sales was a product of price inflation. I mean, I wasn't even paying attention until the last week or two, and all of a sudden I have to put 91 octane in my gas tank, and all of a sudden I'm paying close to $3 a gallon for it, and I was like, whoa, when did that happen? Mm-hmm. So if you strip gasoline out of the retail sales, real retail sales fell even more than 0.2%. So, to me, that reflects the fact that the average consumer, the average household is debt strapped. And at this point, the average household really can't do much more than spend money on necessities.
Yeah, I completely agree with that. Some of the research I'd done last year were that the auto sector and the home sector had started to roll over, not only in the United States, but in other places as well, namely Germany, which is one of the big growth engines for Europe. And so I thought that we were probably reaching the point at which global consumers were probably strapped, not only in the United States, but in other parts of the world as well.
Yes.
And what surprised me was one of the things that I told my readers was, we're going to see what happens during the Christmas season. If we have strong retail sales, that could be the only thing that may save the general economy and the stock market for the short term. Not that we weren't going to hit a recession. And we did have stronger than expected sales retail for the Christmas season. And I thought, okay, how long can this go on? Because if people can't afford the big ticket items, they can't afford to buy homes because interest rates are going up and housing prices are going up across the country. They can't afford to buy cars anymore because the increases in prices of automobiles. And all of a sudden, the iPhone sales started falling. And then now we're starting to see the consumer not able, like you said, not able to make the normal amount of purchases they normally make, and having to scale back and having the debt levels they do. It seems to me that the consumer is the ultimate lever in the economy. If the consumers can't buy, that means corporate sales are going to go down. And if corporate sales go down, how are they going to pay off their debts? And who's going to pay for the debt binge that the corporates have been on for the last 10 years since the last recession? So I don't know if you had thoughts about the corporate debt levels and where we stand with those.
Oh, the corporate debt level, that's a roadside bomb waiting to explode. It's even bigger than a roadside bomb. That may be a small financial nuclear bomb, especially in the triple B rated category, because at some point there's gonna be a massive downgrade of triple B debt to junk, and large investors who are not allowed to invest in junk bonds are going to be forced to sell. But probably the bigger problem, that's kind of what the big storyline is, that with the triple B is the coming wave of ratings downgrades. But really, the reason why the rating grades are coming is because a lot of these companies who issued debt that somehow managed to get a triple B rating on it, a lot of them are going to have problems servicing their debt as the economy continues to head south. And so I think we're probably going to see and I don't know the timing on this. We're going to see a pretty big wave of corporate debt defaults that occurs probably, over the next couple of years. So, the corporate debt is a problem, but again, the consumer represents 70% of the economy. And I've been saying, well, first of all, the level of subprime auto loans that has been issued is starting to, it's not as big as the subprime mortgage level that was issued in the mid 2000s housing bubble, but it's going to be problematic, and you're already seeing delinquency and default rates on subprime auto debt at levels that we were seeing in 2008 and 2009, and that's something that's going to come back and undermine, the booming economy narrative that the current administration seems to be promoting. And the same thing's going to be true with housing, and housing's not a function of interest rates going up. I mean, on a relative basis, we had a higher sales rate of home sales in 2006 when the Fed funds rate was at 6.5% than we do now with the Fed funds at 2.5%. It's not interest rates that have choked off home sales, because essentially mortgage rates are maybe at most 80 to 100 basis points above where they were when they hit an all-time low. I think it was during 2017. Might have been early 2018. I forget exactly. I don't have the chart in front of me, but it's just that you've run out of potential home buyers who can manage a 3% down payment for a Fannie or Freddie mortgage, but not just manage the 3% down payment. And that down payment's not a hard down payment in a lot of cases. You can use seller concessions as part of that 3%, or the realtors can say, okay, we'll concede part of our realty fee, and you can use that as a down payment. There's mortgage brokers in Denver that advertise that they'll pay your closing costs, or they'll subsidize your down payment. I mean, it's unbelievable. I mean, we're right back to where we were with the type of things that caused the Big Short housing collapse. But at any rate, I think, unless the government decides to roll out as a standard mortgage a 0% down payment mortgage, I think you've kind of tapped out potential home buyers who can afford the monthly cost of home ownership. And it's irrespective of interest rates. I mean, the cost of a mortgage isn't that different if your mortgage is 4% versus 4.75%. It's just not that much.
Yeah, and it sounds like what you're describing is we're back to the same position we were leading up to the 2008-2009 crisis, but we may actually be worse in that consumers may have had more room to take on additional debt over the last 10 years. And now that they've done that, they're being set up maybe for an even bigger fall on a personal level than they were even in 2008-2009. I think the 2008-2009 was like a liquidity crisis and a banking system crisis, but the consumers weren't in quite as bad shape, and now maybe they're in that same shape. So at all levels, if you look at the national economy and the amount of debt that we have, the corporates and the consumers, they all seem to be sort of tapped out, where we're reaching our limits of this bubble, this big debt bubble, and where it's all sort of going to kind of burst at once is what it seems like it's going to. Do you agree with that, or do you think that there's any areas that may survive what may be the big debt collapse that we may see in the next few years?
No, you're absolutely right. I mean, in 2008, and the so-called subprime deadbeats are attributed as the cause of the mortgage collapse, and that's not actually what set it off. It was flippers who got stuck with homes. When prices started falling, that's when they started doing the jingle mail, where they would mail the keys to the bank and say, "See you later." And the banks got left with just a massive amount of bad mortgages, but also they were counterparties on mortgage trust related derivatives that were also defaulting, and that was why the banks were bailed out. They were rewarded for their bad business decisions and their greed by being bailed out with taxpayer money. I'm amazed that the pitchforks didn't come out when that happened. But you're absolutely right. This time around, it's not just mortgage related. I mean, this is we're going to see an everything debt crisis. I mean, there's just simply too much debt for the entire system to service, unless they go back to printing more money, which is what I think they're going to eventually do.
Yeah, I definitely agree with that. One of the things that I talked about back in December, I flew out to Phoenix and had a conversation with Lynette Zhang for her YouTube channel, and we were talking about. She asked me about the dollar and where I thought the dollar was going to go, and I said, well, I think the index value is going to keep going up because there's so much debt demand for dollars. To extinguish the debt, you have to use physical dollars, or at least the electronic version of physical dollars, to extinguish that debt. And as all this debt becomes due, people are going to be grabbing for the dollar bill. And there's something like 3.2 trillion in foreign dollar denominated debt that we haven't even really talked about on this program. We just talked mostly domestically. So and there's only 1.6 trillion in real dollars in circulation. So I think the dollar is going to continue to go up on an index basis because it's being demanded to extinguish this debt, but there actually isn't enough cash in the system to extinguish it. So I agree with you. At some point, they're going to have to start reprinting cash to be able to just deal with the debt issue. But I think that's going to lead to problems. I think it's going to devalue. It'll probably be the final nail in the coffin of the dollar when that happens. I don't know where your thoughts are on that.
I don't. The dollar's a complicated issue. And essentially what you're seeing, especially in the Eastern Hemisphere, you're seeing governments reduce their dollar level of reserves. And that, I think there's so many variables, it's really hard to say exactly, what path the dollar is going to take before it collapses. And it's definitely going to collapse. But it's, is there going to be sort of a supernova move higher in the dollar, as there's a scramble for dollars to pay off debts, or At some point, if people stop paying their debts or sovereigns stop, paying their dollar-denominated debts, there's no demand for dollars, right?
True.
So I don't know how that's going to play out. It's certainly an interesting intellectual exercise to kind of play the tape forward, but I don't think anyone really knows how that's going to play out.
So in terms of holding cash, kind of segue into this conversation, how safe do you think the dollar is, and maybe for how long, and what are you recommending to your subscribers in terms of holding cash? Is it wise to get out of some of these debt instruments and go to cash? Is it wise to go into other things like maybe the precious metals, or what are you doing, I guess, to prepare for what's going to be coming up in the economy in the next couple of years?
Well, there's a couple embedded issues there. So, for instance, I think you got to hold cash, because if you got to run to the store will take dollars, but it won't take silver eagles or gold coins. Mm-hmm. So, just for fungibility, you need to hold cash. Now, the question is, do you hold it in a checking or a savings account, or do you put it in a drawer next to your bed? I try to minimize the amount of money that I keep in any custodian, especially a bank, because we almost saw it happen in 2008, where if they didn't bail out the banks, and I don't think they should have, you probably would have seen some bank holidays, and we could easily see bank holidays at some point if for whatever reason they decide not to bail out the banks again. Mm-hmm. So I keep cash on hand, and as much as possible, I try to convert my cash into silver eagles or 1 ounce gold coins, and I only recommend sovereign minted bullion coins, just because the private label coins I think are good value, but if I'm engaged in an economic transaction, someone wants to pay me in silver or gold, that's fine. But if you're I don't want a private label coin, because they're easier to counterfeit than it's very hard to counterfeit a gold eagle or a silver eagle. So I just think ultimately, if things get really ugly, I think you're going to have a higher level of fungibility with sovereign bullion coins that are recognized all over the world versus private label stuff. So that's what I recommend. I try to keep some portion of your wealth in cash and in bullion.
Okay, so basically anything
that I'm wrong, believe me, I own plenty of mining stocks, because if this unfolds the way I think it'll unfold, the mining stocks are going to go a lot higher.
Yeah, so it sounds like you're staying in enough cash to basically cover expenses to deal with any sort of liquidity crisis or bank run situation where you may not have access to it if it's stored, like you said, in a banking system. And then having gold and silver more for the long term as either wealth preservation or as an investment.
Both.
And then you mentioned mining stocks, and that's an interesting subject to get into, because I think the conventional wisdom from a lot of people that write about the mining stocks is they're a leverage play on the precious metals prices, especially if you're going to go to gold and silver. But even to some extent, platinum and palladium as well, especially as palladium has had its meteoric rise. What do you do in terms of investing in the mining stocks, and what is your approach to that?
I'm not averse to risk, so I focus on the junior mining stocks, and that's what my newsletter focuses on. Although I will throw in some large cap ideas. SSR mining is one that I put in there, I don't know, maybe 5 or 6 months ago at $8 or $9, and it's had a nice run. I haven't even looked at the price in a while. And in the last one, so it's at $12.30 now. So it's had a nice rate of return since I featured it as a what I call the large cap, less risky mining stocks. And I put another one in there that's a turnaround situation. It's a large cap or a larger cap producer. I put that one in my last letter. But in general, I focus on the juniors, and I like to look for juniors that, I mean, probably in the last year or two, I've kind of stayed closer to home, North American junior mining companies. I've been bitten in the butt by political risk a few times in the last 3 years, and so I'm more hesitant to go outside of North America for that reason. Not to say that there aren't some great opportunities in non-North American jurisdictions, but you know, you also have to consider the political risk. So and I look for, in general, I look for exploration juniors that I think have a good chance of proving a discovery, and I think that's the most undervalued sector of the precious metals market right now, or the junior mining stocks.
Yeah, I think given it's been getting harder in both gold and silver to find large economic deposits, and it seems like the larger companies are turning to consolidation with other companies to get deposits rather than focusing on the exploration piece. So you've had the big mergers, Barrick and Newmont and Randgold. And it seems like more consolidation. I think RiskReward has said there'll probably be more consolidation in that space he expects to see going forward. And I think that the juniors are playing the role of finding the new deposits, but they tend not to be these, you know, significantly large deposits as we've seen in the past. So what is your view on basically what we're seeing in terms of the deposit sizes we're seeing, and how does that affect your investment approach?
Well, that's another reason why I focus on the exploration juniors, or even there's some juniors that are, you know, not too far away from having properties that are shovel ready, and those are good value as well, because, you know, if you have a junior that, say, has a 1 to 2 million ounce resource, you know, in a prolific gold belt, you know, like up in Canada or in Nevada, at some point, you know, when the Barricks and the Newmonts of the world get done buying reserves, you know, by swallowing large mining companies like we were seeing with Newmont and Goldcorp, and we saw with Barrick and Randgold, you know, they're going to have to turn their sights on to, in order to replace what they deplete, they're going to have to start snapping up the juniors that have resources. So, you know, and it seems like a trend that's going on right now, and has been for a while, is, you know, a lot of these juniors, the ones that are trying to prove a resource and sell the company, they're drilling out their properties as much as possible and aggressively, because they want to prove a large mineralization footprint via, you know, indicated and inferred reserve, and then you know, the idea is you flip it into the large company that'll then spend the money to do the infill drilling. Because infill drilling is a lot more expensive than exploration drilling. So in the small fund that I manage, and in my mining stock journal, I have a handful of those stocks where, you know, it's companies that are just out there, and they're turning out great drill results, it seems like every other month, and these companies eventually are going to be acquired. In fact, one of them, Silvercrest Metals, SSR Mining, took a big investment in it, announced it a couple months ago.
Yeah, that was an interesting play, because Silvercrest had been one of the ones that I had covered a lot in 2018. I met with Michael Rapp. She used to be their VP of communications at the Vancouver Resource Investment Conference last January, a year ago. And I actually got to go on a tour of the Mexican mine at the Babacanora and the Las Chispas project. And it's such a great project that I was really excited about that one, and wrote several stories on it in 2018. And I think investors who had I think when I wrote about it, it was trading like $1.60 something, and then it went up over $3. I think it may still be up over $3 at this point.
Rob, are you sitting in your chair?
Yeah.
I had Silvercrest Metals, and I put it in my short sellers journal as a contra dollar play or a contra stock market play because I hadn't rolled out the mining stock journal yet. I had Silvercrest Metals in my January 10th, 2016 short seller journal at 16 cents.
Oh my goodness. Oh, goodness gracious.
Since then, I knew about that property from when Silvercrest Mine. You know, we were investors in Silvercrest Mines, which was acquired by First Majestic, and then the Las Chispas property was spun off. And I knew about that property going back to then, and I knew that Eric Fear felt that Las Chispas may be bigger than Santa Elena, which is why First Majestic bought the original Silvercrest mines. So now it's a phenomenal property, and now it's just a question of how big it is.
Yeah, the drill results, every time they drill, it gets bigger, and they keep hitting, and they're not allowed, I don't think, to use the term bonanza grades, but I call them bonanza grades. It seems like every time they drill, they hit another streak of bonanza grades. And it's unreal. When I was down there, I think I went down there March 2018, and they had arranged for some professional geologists, metallurgists to go down to write for their respective buy-side companies that do research and make recommendations for these big funds. And so I was chatting with the geologists and metallurgists about the project. I kind of pulled one of the geologists aside at dinner one night and said, "Hey, let's talk about this project. I really want to know your thoughts on what it was." And he just looked at me and said, "Yeah, this is going to be a very, very good silver project." And he said they're going to have relatively low costs for getting it out, and it could. Who knows how long it's going to go on? And I think back then they were advertising there were 9 or 10 veins, and now I think they're up in the 20 or maybe 30 veins that they haven't even explored all of them yet. So
yes,
Silvercrest is going to be bigger even than people realize now. I think it's going to continue to get bigger, and I think Eric is such a great manager and great at what he does. He's gotten his family involved. Both his daughter and his son work on that project, and I met both of them, and they're real. They're both trained geologists, and they're very good at what they do. And he's brought over some people from the finance space to help build, the business side of the house. I met with Chris and the other people on the team. It's a really good team. So management is such a big part of it for me, as well as the deposit. So I'm super bullish on Silvercrest, and I think they'll do very, very well.
I agree with you on that 100%. We own it in my fund, and I still have a standing buy on it in my mining stock journal.
Well, I guess you've done very well if you owned it at 16 cents. So congratulations.
All my investors have.
Yeah, well, that's good. All right, so
the fund. So yeah, it's I'm happy with it.
Yeah, no, that's good. So one thing I wanted to talk about, I went to PDAC in Toronto here back, I guess, at the beginning of the month. And some of the analysts there were saying they think some of the consolidation at the top end of the gold market, especially, these Barrick and Randgold type of mergers, are vying for the generalist dollar, because they think they're seeing the generalist stock riders starting to get back into the precious metals markets and starting to influence the funds that are coming in. And however, only the top 2 or 3 gold companies usually will get that money. And so it seems as though the big gold companies are going to consolidate more in sort of a race for the funds. And some people thought that maybe that wouldn't be good for investors. So do you recommend, investing in the larger cap gold miners? Or I know that you said you prefer the juniors, but do you have any holdings in some of the larger cap companies as well?
I don't, honestly. I mean, I don't care for most of the. I consider, other than Agnico Eagle, I think most of the largest mining companies are not well managed, and they're loaded with bureaucracy. I just honestly don't think they're well managed, and I don't know how much upside there is, trying to speculate on the next takeover in. Well, I say that, I take that back. I think Goldfields probably is an interesting long idea here. I think I think they'll probably get acquired, and I think there's probably some upside there. But I mean, if you look at, when Barrick made a bid for Newmont, it was essentially, what you call a take under. I mean, it was basically, the offer was below where Newmont was trading, and so I don't think you're not going to see giant premiums in these mining giant mergers. At least that's my opinion. So again, I think the game is to wait patiently, sitting in the juniors, because you never know when there's still a lot of M&A activity going on in the junior space. You never know when it's, and I think you're going to see some of the mid-tier gold mining companies like Centerra. I think they're going to start turning their sights on juniors and try and buy up the good ones ahead of the larger ones, and then maybe Centerra gets swallowed by someone. I don't know. I just when I look at the numbers, I see that the junior sector of the space, the junior segment of the space, is historically undervalued right now. The only other time I've seen it more undervalued was in 2000, 2001. Mm-hmm. Is when I got into this sector, and in mid 2015. So and if you look, the juniors as a segment are they're underperforming the larger cap mining stocks, and to me that's potentially the sign of what we're seeing as a healthy rally in the sector, a healthy move, and a longer. To me, it's the signal of a long-term sustainable move move higher in the sector versus what we saw at the beginning of 2016. I mean, the GDXJ went up 300% in 6 months, and then it sold off and has been kind of going sideways ever since. Mm-hmm. To me, I looked at that and I thought it was unhealthy that we went up as quickly as we did. So I like the fact that the juniors aren't moving yet. And eventually they will. And I remember when I got into this sector in 2001, I started buying some juniors. And, there were days when all of a sudden juniors that you would own would go up, 10, 20% for no reason. There wasn't even any news. And I think eventually going to get to a point where we see that again, where all of a sudden the market realizes, man, these juniors are super cheap relative to the rest of the sector. And money starts coming into it. And the juniors, most of the stocks that I look at have less than 100 million shares outstanding. Some of them have, U.S. Gold, for instance, has 19 million shares outstanding. And when you start getting just a little bit of money from institutions moving into that space, these things move really quickly.
Yeah, they definitely do. I agree. And I think there's going to be explosive growth in the junior mining sector, especially in the precious metals. And I would even throw, there's not a lot of platinum and palladium miners out there, but there is North American Palladium, which I met with company officials at PDAC. And I think they're going to do very well moving forward because they don't have the jurisdictional risk of a South Africa or Russia, where we get most of our palladium and platinum from. They're North American owned, and they're based out of Canada, a very safe mining district, very friendly, the government to the mining sector. And so I think North American Palladium is another one that's going to do very well as we go forward, because I think palladium is just getting more and more important to general economic growth. So outside of gold and silver, I think North American Palladium is a really good one that I've looked at. I think last thing for this interview is we kind of wrap it up. I know we've been going for almost 50 minutes here. One of the things that I kind of talked with you about prior to the interview was some of the accounting practices that are going on at some very popular stocks. And the two that I think we mentioned were Amazon and Tesla. So I know you've had some comments on those and where they may be, and they may not be quite as solvent or quite as strong as people may think. So I wanted to get your thoughts to kind of wrap up here on those.
Sure. probably the only really valuable class I had at the University of Chicago Business School was a high-level accounting class. It was essentially a forensic accounting class in terms of, GAAP, generally accepted accounting principles, forensics. And, like marketing, I got a C in marketing. I hated it. I hated the class. To me, it's a touchy-feely topic. But I seemed to be like an idiot savant when it came to accounting. I mean, I got an A in accounting, and I got one of the highest grades in this upper level class. That was essentially, it was the only class of its type offered at the master's level. It was really a PhD in accounting level type class. But at any rate, so like I can look at Amazon or Tesla and see things that a lot of people might not see, or you might need to be a trained CPA to see it. There's certainly plenty of trained CPI eyeballs looking at Tesla, and every quarter they report, it's easy to see where Tesla is either coloring outside the lines of GAAP or stretching GAAP accounting standards to the limits. And unfortunately, since really in the last 20 years, GAAP principles have been really watered down. And part of it is just it's enabled corporations to report paper profits that are higher than actual economic profits, cash profits. And when you dissect Amazon and do it properly, you can see where Amazon burns cash every quarter, even though they report these great earnings per share. And there's a lot of things. There's a lot of moving parts going on with Amazon. It's easier to dissect Tesla because there's not that many moving parts. And they take liberties with all kinds of things, like recognizing provisions for warranty expenses and things like that. Amazon has a lot of moving parts, and you got to really, really dig deep into it to see what's going on there. But you can just, and I've never seen Wall Street analysts do this, but you can just look at the cash flow statement, and if you read the entire thing, you can deduce that Amazon actually burns cash every quarter. And the whole game for Jeff Bezos is to generate sales growth. That's why he's always branching out into these crazy businesses. What happened to the pharmaceutical business that he was supposed to be getting into?
Right.
That was part of the reason why he acquired Whole Foods, though, was to boost his sales growth. And also Whole Foods was sitting on a lot of cash, and Bezos needed cash. So, I did a report that I originally wrote it in 2015, and I think I did the last update in the first quarter of 2016 or something, because it's a lot of work, and I just don't have time to go in depth the way I did on the original report. But the underlying concepts of where Amazon is exploiting GAAP principles still holds true to this day. And I actually include that report with when someone signs up for the Short Sellers Journal. I include that report as part of the welcome email package, so you can sort of see what's going on. And then every quarter, when Amazon reports, I update kind of what's going on with the numbers for my subscribers. So Tesla is just, I've said this since I started looking closely at Tesla about a year ago. Tesla one day is going to be a case study for several areas of business schools, business school curriculum, accounting, marketing, operations management, everything, but especially accounting, because that thing is, if Enron was accounting fraud, Tesla, has redefined accounting fraud.
Mm-hmm.
So,
yeah, and
thoughts on those two companies.
Yeah, and they could probably give a course on how to avoid the SEC when they're chasing after you, because they seem to be immune to whatever scrutiny the SEC.
It's like all the government regulatory bodies. They've been captured by corporate America and Wall Street, and so they're the regulators look the other way until something blows up. We saw that with Enron, and we saw it with Madoff. I mean, that guy Markopoulos, I think his name was, Harry Markopoulos, he put a case against Madoff on the desk of the SEC in the late 90s. And we had to wait until, the stock market was getting ready to collapse before Madoff was fully exposed. Mm-hmm. And before the regulators went after him.
Yeah, and I think in the case of Enron, we had an established auditing firm, it was Accenture, I believe, who was involved in that mess, and they were complicit with basically a lot of what Enron was doing and covering it up and looking the other way. And so
Price Waterhouse has to be complicit with what's going on at Tesla. I'm amazed that or PwC, whatever they call themselves now. It's the only thing I can figure out, because I don't know how Price Waterhouse signs off on the numbers every quarter. I really don't, unless they're getting paid well to do it.
Yeah. Well, that's the thing that I think people may not realize. There can truly never be independent auditing when the company is paying the audit company for their services directly, and they form these relationships at the senior levels of both the auditor and the company, in which both of their successes are dependent upon whatever the charade is keeps going on, whatever the company wants to represent as their success. And I won't divulge too much about my time in audit, but I was an auditor for 12 years, and I worked for both KPMG and EY, as well as an internal auditor for a couple of different companies. And I won't give examples, but I can just attest to the fact that I've seen auditors look the other way when the company really put a lot of pressure on them.
Yeah, absolutely.
And I've seen it from the inside. And there's this whole concept. I think it may have started with Reagan, or maybe he made it famous, at trust but verify. And after I spent so many years in audit field, I turned that on its head and I said, verify and then trust. I don't trust anything that comes out of anybody's mouth unless I can verify it for myself. And if I can't, I'm sorry. I'm just going to be skeptical. I'm not going to say that it's not truthful, but I'm going to be skeptical until I can see the truth for myself. And
well said. I agree with that.
That's what the audit profession taught me. So that's a good warning to people out there investing in stocks and things. Just make sure that you have a good bit of skepticism over what's being reported, and don't get caught up in all these various scams that seem to pop up, especially when we have an aging bull market in an economy. These scams tend to pop up more and more.
Yes, absolutely.
Oh, Dave, anything else? I think we've run through the topics that you and I discussed for the interview. But anything else that you wanted to share with our listeners?
No, I think we've probably exhausted their ears at this point. It's very comprehensive. I enjoyed it.
I did too. I wanted to thank you again for hopping on with me. I really like doing these collaborative projects, and certainly learn a lot every time I do them. So again, for your readers, go to your website and catch you on Seeking Alpha, as well as your newsletters. And I'll post links on for all of these things for you when this gets published. Thanks again.
Thanks, Rob.
This has been a Gold Silverpros production. Please subscribe to us on YouTube and sign up for our newsletter on goldsilverpros.com.